What a week. The so-called mini-budget has been scrapped. It seems like the money markets are calling the shots on what happens with UK government policy. Vladimir Putin makes some potentially useful remarks for property investors. But what does all this mean if you're investing in property and you're looking to succeed in property over the next couple of years? In this video, we'll be piecing this all together. Before we get started with the video, let me tell you about this month's Baker Street Property Meet. It's the UK's largest property investors networking event where you can network with 300 property investors. It's on the 26th, Wednesday, 26th of October, 6 p.m. in central London. Our theme for this month is Brace for Impact and Prepare for Opportunity. We're joined by special guest tax barrister Mark Smith, and we'll be looking at how you can prepare yourself for the impact, the fallout from all what's happened from the mini-budget, so you are left in a position where you're prepared for the opportunities that will come when the recession starts to take hold. To find out more and to book your place, because places are booking up very, very fast, go to bakerstreetpropertymeet.com. Now, when you're in government, you plod along and you do your stuff, and there are events that happen. The shit hits the fan. I mean, COVID was an example of that. The 2008 credit crunch when Lehman's collapsed, that was another example when the shit hit the fan. But what's happened in the recent weeks has been unique in British history. The shit hit the fan all right, but it was Liz Truss holding the fan and Kwasi Kwarteng dishing out the shit. Now, what basically happened is they put out this mini budget. They wanted to announce a whole bunch of tax cuts and massive spending with this energy support package for 2 years. And they didn't explain how this was going to be funded. Now, the UK has always run on a national credit card. And from time to time, the UK increases the limit on its credit card. But guess what? It always has a credible plan for paying off the minimum monthly balance each month, minimum monthly instalment each month, and paying off a little bit of the capital. And for that reason, because it had that credible plan, the lenders, the backers, were always okay with the way we were using the credit card. What's happened with this mini budget is they've gone along and said, look, we want to max out the credit card, but you know what? We're not giving you any plan of how we're going to make the minimum monthly repayments or any plan as to how we're going to repay the capital. And that basically spooked the markets. I mean, it didn't help that they refused to go to the Office of Budget Responsibility to independently analyse the figures, but they produced a little bit of analysis anyway, which is shown on this chart. And you can see what's going on here. So what this graph shows is the extra government borrowing requirement as a direct result of this mini budget. And you can see there's this massive spike in 2023-2024. And more than half of that extra debt over the next 2 years was because of that energy price capping policy, which was completely unfunded and very ill thought out. Now, it's all very well doing all this borrowing, but you've got to pay it back. And you can see from this little graph, again from the Office of Budget Responsibility, there aren't enough tax receipts to actually cover this amount of borrowing. And remember, of course, if interest rates goes up, and interest rates have gone up nearly fourfold for the government, that means the cost of servicing this debt is also going up each and every month, and that's by billions. Now, when Margaret Thatcher cut taxes in the 1980s to stimulate growth, firstly, inflation was under control, and secondly, they were running a budget surplus. So when your tax receipts are more than what your spending is, then with that surplus, you're free to do whatever you like. You can inject that into whatever policy commitments, manifesto commitments that you have. But if you're not running a surplus, you're running a deficit, that means you have to borrow that money. And you have to explain yourself, not just to the electorate, but to your lenders, your financial backers, and you've got to demonstrate that you have a clear plan for paying the money back. Now, what's happened here is that borrowing money to fund tax cuts are basically two things that just put petrol on the fire of inflation. Inflation is not under control yet. Giving people tax cuts, of course, stimulates inflation. Borrowing money to pay for it because its deficit also stimulates inflation. So it'll only make that problem worse. And this all spooked the markets. What the markets were saying is that government debt is a bit more risky and we're only interested at a higher rate of return, a higher rate of interest. When the government loses confidence among its lenders, then the rate of government borrowing goes up. Now, the buyer of government debt in the UK is predominantly UK pension funds. Now, if pension funds have a liquidity crisis, then that has a direct effect on property investors. More on that coming up. The last few weeks have seen absolute turmoil in the markets and, quite frankly, a near collapse of the UK economy. What's really saved the day is a few sticking plasters that central banks around the world have for just riding things out. But you can use a sticking plaster on a little cut or scratch, but if you have amputated a leg, then the sticking plaster will only be so much use. In the UK, the Bank of England has some imaginatively named acronym, the TECRF, which is the Temporary Expanded Collateral Repo Facility. What that basically is a mechanism for the Bank of England to step in at times when no one wants UK government bonds and basically print some money to buy them, which of course is further inflationary, and that's why it's a sticking plaster. It can only be used for a couple of weeks, and that's why the Bank of England said after the 14th of October they weren't going to do this anymore. In the US of A, they have something similar. The Federal Reserve Bank has something called the MMLF, the Money Market Mutual Fund Liquidity Facility, which, believe it or not, is actually pronounced MILF. They've done that on purpose. Someone's having a bit of a laugh, isn't there? Anyway, but these facilities exist among central banks as that sticking plaster because there'll always be moments of illiquidity in these bond markets. But what's happened in the UK, I mean, they've used this sticking plaster, the TECRF, to buy these government bonds and all of that UK government gilts. But that cannot last forever because what's fundamentally happened is not just a temporary blip in the markets, but a complete loss of confidence in the people at the top that are dictating government policy and, more importantly, fiscal policy. A reputation takes years, decades to build up, but it can be lost in just a moment. The UK's financial reputation was up there with US and Germany and those sort of countries, but now seems to be languishing down there with Italy and Greece. When the toothpaste is out of the tube, it's not easy to stick it all back in again. Interest rates would have gone up in the UK anyway, but thanks to Kamikaze, Kwarteng and Liz Don't Trust's catastrophic Mni-Budget, the loss to UK PLC's reputation has been absolutely horrendous. Now, Jeremy Hunt is the new guy in charge. He has done something to alleviate the markets, but he's not going to be able to put all the toothpaste back in the tube. Now, all of this stuff is quite scary. You can be working hard, saving your money, but you know what? The powers that be are just inflating it out of existence. Every time they print more money for purchasing government bonds or have deficits going on, that is stoking inflation, that is eroding the value, the true value of the pounds that you hold. Vladimir Putin came up with some very interesting words of wisdom in a speech recently. The economy of imaginary wealth is being inevitably replaced by the economy of real and hard assets. The imaginary wealth that he's referring to is basically fiat currencies, whose value is basically destroyed as a direct result of policies from central banks, as compared to hard assets, natural resources, commodities, food, basically things that people need. And property or real estate is one of those hard assets which everyone needs. Now make sure you smash that like button, also subscribe, hit the bell icon so you're notified when we upload more content. Now I'm going to pull this all together and let you know what all of this stuff actually means for property investors, and it means an awful lot, so stay tuned. But I'll just briefly summarize what Jeremy Hunt has announced. All of that general stuff you can read in the regular press. But the real summary here is that he's pretty much unwound virtually all of the Mni-Budget. This is a massive U-turn. There's nothing left of Truss's economic policy. There's no cut in income tax. The planned rise in corporation tax is going to take effect from next April, 25%. That will affect a lot of property businesses, of course. Now, the energy subsidies are not going to be 2 years. Now, this spooked the markets quite a lot because this added hugely to the government debt, as I showed you before. This is now, the support program is going to be until April 2023, and then they're going to review it and come up with something else. Changes to off-payroll working, IR35, are going to be scrapped. Unfortunately, the tax reductions in booze are going to be scrapped, so they're staying the same. But the interesting news is that the SDLT, the stamp duty changes in terms of the limits and thresholds that were announced in the mini-budget, they are staying intact, so potentially some good if you're only buying new properties. So what does all this mean for property investors? UK government borrowing is massive and is continuing. The lenders are only happy to continue lending to UK if there is a clear plan for paying it back. And that basically means inflation must be brought under control and there must be some tax rises to make sure that we're not running a deficit between tax receipts and government expenditure. The government has no wiggle room on that. It's something they must do. The only way to reduce inflation is to raise interest rates, and interest rates have to be raised to a level which will cause a recession. Recessions create both threats and opportunities for property investors. We will see some falls in residential property values, but don't be fooled by averages. There are some areas which will fall quite a lot, and there are some areas which won't fall that much at all. There will also be massive variation according to property types. Flats which are leaseholds with high service charges are likely to fall more. Things like shared ownership type schemes are likely to fall more, much more than, say, freehold properties in relatively prosperous areas where there's good employment prospects and still limited supply. So what's going to be absolutely key in investing in property over the next year is getting your goldmine area absolutely correct. There's going to be a massive issue for people coming off fixed rate mortgage deals, particularly buy-to-let deals, because interest rates will go up. Base rates could end up hitting 5% by mid next year. After that, I believe they should edge down a little bit. But during that interim period, if you've got fixed rates coming to an end, you can be exposed. You may not be able to meet the lender's criteria to borrow the same amount of money again because the rate of interest that you'll have to pay has gone up so significantly. Now, one thing that will stay strong, though, is rental demand. There's a massive shortage of rental property. I'm not sure whether rental prices are going to increase that much from where they are now, but certainly demand will be very, very strong. I hope you're liking this video. Smash the like button, also subscribe, hit the bell icon, because we'll be putting out regular updates to keep you informed. Now, what I want to share with you is something that's happening with the pension funds and the opportunities this is going to present for the smarter, savvy property investors. Now, the pension funds, as we all know, have gone through a massive liquidity crisis in recent weeks. So pension funds invest in UK government bonds. They've got a liquidity crisis. Another big thing they invest in is UK commercial property. They invest in commercial property directly and through commercial property funds traded on the stock exchange. Now, the FT reported that after the mini-budget fiasco, which caused a massive issue with the bond market, it's basically affected pension funds' liquidity, and they have a massive issue with commercial property right now. As this article in the FT shows, that a lot of investors have actually withdrawn money from UK commercial property funds. And as is patently obvious, rapid withdrawals pose a problem for some property funds, which can take several months to offload properties in their portfolio. Basically, if people want out of the fund, they've got to divest of their commercial property holdings. So let's sum up what's happening for commercial property and what this means for savvy property investors. Now, we were already facing recession anyway. Recession obviously affects businesses. Businesses occupy commercial property. There are more commercial properties available during recessions. COVID accelerated so many trends that were playing out anyway, in that now there's an oversupply of offices and retail premises anyway. As interest rates are rising, it means that pension funds who hold commercial properties are thinking, well, okay, we expect a higher yield from our investments. If we can get 4 or 5% from a government bond, why should we own a commercial property on a buy-to-let basis, which is generating the same or not much more than that? So they tend to divest of commercial properties for those sort of reasons as well. So there are a whole host of reasons why a whole load of commercial properties are about to enter onto the market. And that's why Goldman Sachs have predicted that commercial property values, commercial property buy-to-let values will fall by 15 to 20% over the next couple of years. So here is the opportunity, folks. Commercial property is always valued at a far lower rate than residential property per square foot. In typical times, residential property is priced 3 or 4 times higher than commercial values. But with all these factors that I've talked about so far, commercial properties are going to fall much, much more per square foot than their residential equivalents. This is the first recession that we've ever had where you actually have permitted development rights which allow you to repurpose defunct commercial buildings to residential use without going through planning permission. And if you repurpose these commercial properties to make one-bedroom flats for rental in good rental areas, then what you will have is a cash flow producing hard asset. Now, if you want to learn more about this strategy, I'm running a special 90-minute masterclass where I'll show you exactly how to put these sort of deals together in the current market. I'll show you exactly how you can find these deals, fund these deals, and convert these properties into rental stock, cash out on your properties, and produce positive cash flow. If you want to learn more, join me on my free 90-minute masterclass. The link is on the screen below and in the description, property-workshop.com. That's all for this video, but if you want a little taster of what I'm talking about with converting commercial buildings to residential rental units, have a look at one of my students' case study deals up here. It's an office building converted into 12 one-bedroom rental flats, and join me in the next video. We've got all sorts of economic uncertainty, and if you want to know how to navigate your way through all of that and to figure out the right strategies for going forward, you need to be at the Baker Street Property Meet. Our next meeting is Wednesday, 26th of October, and we're going to share with you strategies to help you brace for the impact of the oncoming recession and prepare for the multitude of opportunities ahead. We're joined by our special guest, barrister, a tax specialist barrister, Mark Smith, who's going to share with us a whole bunch of strategies for basically minimizing tax on buy-to-let investment property. So you'll be able to join 300 property investors at the Baker Street Property Meet. See you guys there.